For those of you who could not be here last night for the dinner, I want to recognize and congratulate once again Dan Dalala. Where is he? Dan? Well, anyway, Dan is a 73 graduate of VSB. He's the president of BPG Properties. And last evening he received the Father Joseph Bartley OSA Alumni Medallion. And he was here. I think there was some property he had to sell or something. So but we congratulate Dan once again. I also want to recognize some individuals who are here that serve as the Board of Trustees at Villanova University, and I'm very happy to have them here. Terry O'Toole, who is the chair of our Board of Trustees. Jim O'Donnell, who will be part of the panelists later on this afternoon, and Denise Devine, who has been a very active member of the board for several years now and is very involved with VSB. So I welcome all of them here today. At lunch, I'm actually going to give you an update on what's happening at the university, and I will answer all of your questions. I know there's some that are more important to you than others, and that's Dan Dalala right there. Charles Plosser is the 10th President and Chief Executive Officer of the Federal Reserve Bank of Philadelphia. Prior to coming to Philadelphia, President Plosser was the John M. Olin Distinguished Professor of Economics and Public Policy and the Director of the Bradley Policy Research Center at the William E. Simon Graduate School of Business Administration at Rochester University. That's a lot of names. Where he also served as dean from 1993 to 2003. He was the Professor of Economics in the Department of Economics at the University of Rochester, Senior Associate at the Rochester Center for Economic Research, and Research Associate at the National Bureau of Economic Research. He has served as co-editor of the Associate Editor of 3 prestigious journals of economics and reference for over 1,000 others. He earned his PhD and MBA degree from the University of Chicago and his bachelor's degree in engineering from another school that begins with V, Vanderbilt University. President Plosser has served as the consultant to numerous corporations, including Chase Manhattan Bank, Eastman Kodak, the Wyatt Company, on topics ranging from pension fund management, capital budgeting, and financial analysis. It is a great honor for him to be here, for us to bring him here. It's an honor for him to be here as well. But it's a great honor for Villanova to welcome him here today. So welcome, President Plosser. I know you feel that way.
I do feel honored to be here, and it is a great pleasure to be here with all of you and take this opportunity to talk a little bit about the economy and share some time with those of you who are visiting here at Villanova. You've done a great job with a wonderful institution, so congratulations, and I'm delighted to be here. All of you as leaders in your respective businesses or communities are well aware of sort of the painfully protracted pace of our economic recovery. And I've been saying for some time, almost since the very beginning of this crisis, that this was going to be a long, slow slog in recovery. And it's particularly frustrating, I think, that this long, slow slog is continuing, and this state of affairs is continuing, despite the fact that we've had some of the most extraordinary accommodative monetary policy in the history of monetary economics and central banks. So in my remarks today, I'm going to discuss a little bit about the outlook for the United States economy, as well as my views about the appropriateness of monetary policy. I always have to throw the caveat in, and those that follow the Fed probably know why. As always, my remarks reflect my own views, not necessarily those of the Federal Reserve Board or my colleagues on the Federal Open Market Committee. So let me begin with an update on the U.S. economy. Clearly, this year has not played out according to the forecast. Indeed, from the revisions to the government's economic data in July, we now know the recession was deeper and the recovery weaker than we had previously thought. Some of this year's weakness is perfectly understandable. We began the year with a severe snowstorm in the east, then an earthquake and the ensuing disasters in Japan, followed by the unrest in the Middle East and Northern Africa, and the run-up in oil prices, and lingering concerns from Europe about their sovereign debt crisis. And that just got us to May. With the arrival of summer, we faced another round of problems with the worsening of the European sovereign debt crisis, as well as our own fracas on fiscal policy and the debt ceiling debates in Washington. All of these events have weighed heavily, I think, on business and consumer confidence. So while many of these factors are transitory, and each will wane eventually, the cumulative effect has served to feed uncertainty and inhibit growth. Indeed, growth in the first half of 2011 was much weaker than anticipated, as I said. And of course, in light of the fact that the year is now half over, and the first half was very weak, everyone is busy writing down their forecasts for 2011. I myself expect growth to be less than 2% over the fourth quarter to fourth quarter for 2011, but I expect it to gradually accelerate towards the end of this year and into next to about 3% for 2012. Although the downside risks to this forecast are significant, I do not believe the data signal that we are on the precipice of a so-called double-dip recession. Indeed, many of my own business contacts suggest that while growth is very sluggish and certainly uneven, they do not see the sort of precipitous declines that the news headlines sometimes suggest. Instead, their stories are consistent with a slow recovery due to the nature of the recession from which we have emerged. The financial crisis was a severe shock that impacted many economies around the world and led to a recession of great depth and numerous structural imbalances. Some sectors of the economy, for example, financial services, perhaps construction, may never return to their pre-recession shares of our economy. The aftermath of the financial crisis and a weak housing sector will weigh on the pace of recovery for some time to come. One of the more striking aspects to this recession is the continued weakness in consumer spending. There were modest increases in consumer spending last year, but spending decelerated notably during the first half of 2011. Partly this reflects the lingering effects of higher oil prices we saw earlier in the year. Partly it reflects the continued deleveraging of household balance sheets as consumers pay down debt and work to rebuild their net worth. Most observers agree that weak income growth and flat to falling housing prices are restraining spending, and we are unlikely to see strong consumer spending as long as we face a depressed housing market and a weak labor market. Another way to view weak consumption more from an economist's point of view is to note that households are continuing to restructure their balance sheets, as I said, saving more and consuming less. This is a perfectly natural and rational reaction to the events they faced. Until these households perceive that they have restored a balance to their long-run consumption savings patterns commensurate with their earnings profile and their wealth, they will not increase spending. Moreover, the more uncertain they are about their own earning power, the more reluctant households will be to increase spending, and the more they'll feel the need to rebuild and build and increase their savings. This is a painful, but at the end of the day, healthy adjustment for the U.S. economy. A brighter spot has been business investment spending, which has been supported by solid growth in corporate earnings. Looking through the month-to-month volatility, spending on equipment and software has continued to expand this year at a fairly healthy pace. Indicators from business surveys, including the Philadelphia Fed's own Business Outlook survey of manufacturers, suggest some weakening of economic conditions, though it's really too soon to tell how persistent this will be. Many observers who watch these surveys have taken note of the weakness in our monthly survey, the BOS, because it's proven to be a useful gauge for national trends in manufacturing. In August and September, after having fairly strong numbers for over 2 years now, the measures of activity in our survey turned negative. But our polling in August, the way the survey is constructed, coincided in the midst of the volatility and aftermath of the downgrade in U.S. debt, Standard & Poor's downgrade of U.S. debt. And in September, it occurred the week after 2 hurricanes hit our region and with massive flooding in both New Jersey and Pennsylvania. Measures of future activity, however, have remained positive. In September's future activity measures were stronger than August, suggesting that these firms do expect a pickup over the next 6 months. Recent volatility in the financial markets has contributed to sharp declines in business and consumer sentiment. But with a high degree of uncertainty in the business community and among consumers over future taxes and regulations, the financial ramifications of Europe's sovereign debt situation, it probably comes as no surprise that sentiment is flagging. But this sentiment flagging poses added risks to our growth forecasts. Turning to labor markets, they remain a serious challenge. Given the weak growth so far this year, we simply have not made even modest progress on reducing the unemployment rates that many forecasters had anticipated. Most recently, non-farm payroll employment was flat in August, and the unemployment rate remained at 9.1%. Private payrolls added just 17,000 jobs, net jobs in August, far below what we need just to keep pace with changes in the labor force. Ongoing budget pressures in state and local governments have contributed mightily to a fall off in jobs as they've cut public payrolls. All of these numbers are troubling, especially when more than 40% of the unemployed, or some 6 million people, have been out of work for 27 weeks or longer. This underscores that we should not expect an easy solution. Millions of unemployed workers may take longer to find jobs because their skills have depreciated, or they may have to seek employment in new sectors or new regions of the country. These sorts of adjustments and imbalances will take time to resolve. Jobs and workers will need to be relocated across the economy and across sectors, and unfortunately that is a long and painful process. Thus, while I expect a moderate recovery to continue and to strengthen over time, I expect to see only modest declines in the unemployment rate, with probably little change over the rest of this year, but then gradually falling perhaps to 8.5% or 8% by the end of 2012. Let me now turn to my outlook for inflation. Just as growth has been weaker than many forecasters thought earlier in the year, inflation has been higher than expected. Monthly changes in inflation have moderated somewhat from those seen earlier in the year as oil prices have come down. However, measured over a year-over-year basis, total inflation and core inflation continue to advance. I do anticipate that with many commodity prices now leveling off, or in some cases even falling, and inflation expectations relatively stable, inflation will moderate in the near term. However, we must continue to monitor this situation very carefully, particularly in this environment where very accommodative monetary policy remains the current stance. Indeed, it's good to remember that current inflationary environment is quite different from the one we faced a year ago when we embarked on the so-called, QE2 and everything goes dark. Father, did you have something to do with this?
If we had more donations, we could pay for them.
Even a monetary policy maker can't say, "Let there be light." I'll try to continue on here and keep the jokes to a minimum because they're not very good. It's good to remember. Is that microphone still working? Yeah. Oh, okay. It's good to remember that current inflationary environment is really quite different today than it was when we embarked on QE2. That is the purchase of $600 billion of long-term treasuries last fall. At that time, there were concerns about deflation, whereas now inflation is running well above what most policymakers view as the longer-run goal. I would also note that unemployment was higher last fall than it is today. Thus, with higher inflation and unemployment rates lower, it's appropriate to ask the question, what is the criteria we're using for adjusting policy on an ongoing basis? In this environment, I think it's very important that we refrain from actions that risk fueling a steady rise in inflation or inflationary expectations over the medium term. We must not be too sanguine that high unemployment will lead to low inflation. The lesson, just delayed reaction to my plea, right? The lessons of the 1970s remain very clear. High unemployment or low resource utilization is not sufficient to prevent high rates of inflation. The current environment, actually, in the UK should be a warning to us. The unemployment rate in Britain is in the neighborhood of 8% after having risen sharply during their recession. Yet inflation in the UK is now approaching 5% and has been rising fairly steadily for the last 2 years. So this brings me to a discussion of recent actions of monetary policy, explain why I dissented from these actions in August and September, and what I believe to be the longer-term framework for monetary policy. As I noted at the beginning of my remarks, the economic conditions of the past few years have led to extraordinary monetary policy accommodation. To date, our actions have led to a level of the federal funds rate, the traditional instrument of monetary policy, that has been near zero for approaching 3 years. The Fed's balance sheet has grown more than threefold, from about $900 billion before the crisis to close to $2.9 trillion today. Its asset composition has significantly changed from mostly short-term U.S. Treasuries to long-term U.S. Treasuries, mortgage-backed securities, and government agency debt. This extraordinary change in the stance of monetary policy and degree of accommodation has played a role in supporting the recovery so far, and it will continue to do so. In August, the FOMC changed its guidance about expectations for the future path of the federal funds rate, our policy instrument. In particular, it stated that economic conditions were, quote, likely to warrant exceptionally low levels for the federal funds rate at least through mid-2013. At its meeting last week, the FOMC announced additional accommodative action in an effort to reduce long-term Treasury yields from their already historically low levels. To do that, it intends to purchase $400 billion of longer-term Treasury securities and to sell an equal amount of shorter-term Treasuries by the end of by June 2012. This action will not increase the size of the Fed's balance sheet, but it will lengthen the maturity of the Fed's holdings. In addition, the FOMC will be reinvesting the principal payments from its holding of agency and mortgage-backed securities into mortgage-backed securities rather than Treasuries. This action is intended to help support mortgage markets. I dissented from both those decisions because I believe they will do little to improve the near-term prospects for economic growth or employment, but they do impose real risks. Policy actions should never be taken or considered to be freebies. They should be evaluated based on the costs and the benefits. Based on our experience with Operation Twist in the 1960s, which is much like what we're doing today, and on our experience with QE2, the likely effect of these actions of Operation Twist on long-term treasuries is likely to be considerably less than 20 basis points. That's 20 basis points off a Treasury bill yield that's currently yielding about 2%. Again, historic low. The pass-through rate to rates at which consumers and businesses actually borrow is even much less than that. Thus, I'm skeptical that this will do much to spur business to hire or consumers to spend, given the nature of the structural adjustments occurring in the economy and the uncertainties posed by the fiscal challenges both here and abroad. Indeed, I think one of the largest uncertainties weighing on the minds of consumers and businesses today is the sovereign debt crisis in Europe, how it will play out, and what the consequences might be. In addition to having little effect on our most serious problem, unemployment, these actions do come with potentially serious costs. We have provided a great deal of monetary accommodation to the economy, and given the stubbornness of the unemployment rate in responding to these conditions, we should be skeptical that additional adding of a few basis or reduction of a few basis points is going to be the trigger that unclogs the unemployment problem. We should be cautious and vigilant that our previous accommodation policies do not translate into a steady rise of more than it's already done in inflation over the medium term, even if the unemployment rate remains elevated. Creating an environment of stagflation reminiscent of the 70s will not help businesses, will not help the unemployed or the consumer. It is an outcome we must carefully, very carefully, guard against. We also need to ensure that Fed policies remain credible. In my view, the actions taken in August and September risk undermining the Fed's credibility by giving the impression that we think such policies can have major impacts on the speed of this recovery. It's my assessment they will not. We should not take actions simply because we can. To address our nation's economic ills, we must apply the appropriate remedies. A doctor who misdiagnoses a disease and prescribes the wrong medication can actually make the patient worse. The ills we currently face are not readily resolved through ever more accommodative monetary policy. If we act as if the Fed is able to solve all our economic problems, the credibility and confidence of the public in the institution will be undermined. The loss of that credibility and confidence could be very costly to the economy because it will make it much harder for the Fed to implement effective monetary policies in the future. Credibility was also at the center of my opposition to changing the forward guidance in August. I was concerned that tying monetary policy to calendar time could be misinterpreted by the public as suggesting that monetary policy is no longer contingent on how the economic outlook evolves. It could also lead to a loss of credibility should economic conditions develop in a way that requires the Fed funds rate to be adjusted prior to mid-2013. And in my view and in my forecast, given the outlook, economic conditions are likely to warrant us to begin raising the rate before 2013. It also sent a signal that the Fed had very little confidence in the growth of the economy for the next 2 years, which I don't think helped confidence. Finally, the actions taken in our last meeting will make our exit from this period of extraordinary accommodation more complicated. We will have more long-term Treasury securities, more mortgage-backed securities on our balance sheet and in our portfolio, which is likely to extend the time it will take to withdraw from allocating credit to particular sectors of the economy and return to our stated goal of an all-Treasuries portfolio. Now, let me hasten to add, this does not mean that I see no circumstances under which further monetary policy action should be taken. Should the developments in the euro area lead to significant financial disruptions, the Fed would need to respond in its role as lender of last resort to support and protect financial stability and our payment system. Or, if deflationary fears were to become real and a real threat again, and we saw signs that the economy was moving to a sustained disinflation with declining inflation rates and inflation expectations, then the Fed should and will need to take steps, further actions to stabilize those expectations. I do not see either one of those things happening or as likely outcomes, so I do not anticipate that further monetary policy actions would be called for unless those things occurred, which I don't think they will. The last 3 years have proven to be challenging times for monetary policy makers, both here and abroad. We entered an unprecedented territory as we employed new policy tools to stem the financial crisis and limit the damage to the economy from the severe economic recession. There was no established framework for making policy decisions in such an environment. And that added to the difficulties in determining what appropriate policy was or should be. It also created many difficulties for the Fed's communications. In my view, a high priority for the Fed must be to strengthen our monetary policy framework, articulate the framework to the public so that they can better understand the basis for our decisions and be better able to formulate expectations of what future policy actions might be. An important first step in that direction for me is for the Federal Reserve to adopt an explicit numerical objective for inflation. The explicit inflation goal would help to anchor inflation expectations, raise policy transparency, and increase the central bank's accountability for its actions. There's considerable evidence that the countries that have adopted such an objective as a cornerstone of their monetary policy decision-making framework have had more success in achieving price stability without deteriorations in the ability in real economic activity. In the United States, the Congress has given the Fed a mandate to promote the goals of maximum employment, stable prices, moderate long-term interest rates. In my view, price stability is the most effective way for monetary policy to promote those other two goals. Thus, by helping the Fed achieve and maintain price stability, an explicit inflation objective would help the Fed promote all of the three goals set forth by Congress. For nearly 20 years, long before I became part of the Fed, I've advocated that the Fed make such explicit commitment. I believe now is an opportune time to do so. First, it will increase the credibility of our commitment to keeping prices stable, even when we employ these new, less familiar tools. Second, we face an environment where many are questioning the ability or resolve of our government to address our long-term fiscal problems. In such an environment of uncertainty, the Fed, by being explicit about our inflation goal, will underscore our commitment not to succumb to external pressures to use inflation as a solution to our long-term fiscal problems. This will help anchor inflation expectations. And anchored expectations, you hear Fed officials talk about this all the time, are important because an undesirable rise or fall in inflationary expectations can generate a self-fulfilling inflationary or deflationary process. Should inflation expectations become unhinged, should the public lose confidence that we'll maintain price stability, it would be very difficult and costly to the economy for monetary authorities to reestablish price stability. Third, communicating an inflation objective will clarify the Fed's intentions regarding the level of inflation it considers consistent with its mandates. Some economists have suggested that raising our inflation goal to perhaps 3% or more could be an effective tool for lowering real interest rates and maybe for further stimulating and boosting the pace of recovery. I'm very wary of such a strategy because I don't believe we can control expectations that precisely. And for me, it's even questionable whether we could credibly raise inflationary expectations at all. And even if we were able to raise them, how easily would we be able to bring them back down? Trying to manipulate the public's expectations may risk undermining the public's confidence in the institution and unleashing an inflation that may prove very difficult to regain control of. Fourth, we eventually will need to normalize our monetary policy and exit from this period of extraordinary accommodation. Having an explicit inflation objective will help us maintain our commitment to price stability while we do that and increase our commitment and confidence in the eyes, our commitment in the eyes of the public. As business leaders, most of you are well aware of the importance of credibility in your own institutions. An institution's reputation is built on its credibility in fulfilling its commitments. Once that foundation is compromised, it's very difficult to rebuild. The Fed must do all it can to preserve its hard-earned reputation and credibility. And I think an inflation objective can help do that. In summary, the U.S. recovery will continue and gradually strengthen over time. I expect annual growth to be a little less than 2% this year, but gradually accelerating into next year. As the economy strengthens, prospects for labor markets will continue to improve modestly, and the unemployment rate will gradually decline. Too gradually for many of us, but nonetheless gradually decline. As we move forward in this time of change, the Federal Reserve remains committed to its long-term statutory goals of price stability and maximum employment and low moderate long-term interest rates. But we remain vigilant on inflation and committed to clear communications of our monetary policy. I believe that this communication and our accountability to the public would be greatly enhanced if the Fed were to adopt a numerical inflation goal, as I've argued. Having such an objective in place would prove particularly useful in the current environment in which the Fed is providing monetary policy stimulus using new tools that are not familiar to the public or the markets. It will also help in a time when some may view the fiscal situation as threatening the independence of the Federal Reserve in monetary policy. And it will help in the future during our eventual exit from these extraordinary circumstances. Thank you very much.